How longer amortization periods are trapping mortgage holders and increasing their interest payments for years to come. The hidden risks of extended mortgage amortization in Canada. In a recent article on September 4, 2023 by Bryan Labby for CBC News, the author sheds light on the growing trend of longer amortization periods in the mortgage industry and its implications for homeowners in Canada. With insights from industry experts and financial educators, Labby explores how opting for extended mortgage terms can leave homeowners feeling financially trapped, burdened by increased interest payments, and jeopardizing their savings and retirement plans. The article begins by highlighting the experiences of Max Singh, a Calgary mortgage broker with 2 decades of experience. Singh observes a growing number of clients opting for longer mortgage amortization periods, extending up to 30 or even 35 years. These extended terms are sought by both those looking to refinance existing mortgages with variable interest rates and first-time homebuyers. One significant driver behind the shift towards longer amortization periods is the desire to lower monthly borrowing costs, especially in the face of rising interest rates. Many homeowners who initially chose variable interest rates are now extending their amortization to alleviate the impact of increasing interest rates on their monthly payments. Additionally, some clients turn to private lenders when they can't secure financing from big banks, often leading to higher interest rates and increased long-term costs. 2 of Canada's major banks, RBC and TD, have reported a significant increase in customers seeking longer amortization periods. RBC disclosed that 43% of its mortgages have amortization periods greater than 25 years, with 23% extending beyond 35 years. TD Bank's figures are slightly higher, with 48% of remaining amortization periods exceeding 25 years, and 23% extending to 35 years or more. The Credit Counseling Society, a nonprofit organization specializing in budgeting and debt restructuring, weighs in on the issue. Financial educator and credit counselor Mark Kalinowski expresses concern over the involuntary nature of these extended amortization periods. He points out that many homeowners are trapped into them, leading to substantially higher interest costs, often tens of thousands or even hundreds of thousands of dollars more over a 35-year period compared to a 25-year term. This financial burden can hinder individuals' ability to save money and plan for retirement, ultimately resulting in long-term hardship. The longer amortization periods, with their increased interest payments, create a ripple effect on homeowners' financial well-being. By diverting a significant portion of their income toward mortgage payments, individuals have less disposable income for savings and investments. This, in turn, can delay retirement plans and limit their ability to build wealth over time. The Canada Mortgage and Housing Corporation, CMHC, observes several trends since the Bank of Canada began raising its benchmark interest rate in early 2022. In response to these rate hikes, borrowers are adjusting their behaviors. One notable trend is the emergence of shorter mortgage terms paired with longer amortization periods. Homebuyers are opting for 1 or 2 year mortgage loans to reduce their immediate debt service and monthly costs, even if it means extending their mortgage repayment over a more extended period. As traditional lenders, such as Canada's big chartered banks, tighten their lending criteria, the CMHC notes a rise in the popularity of alternative lending sources. This trend underscores the challenges some borrowers face in securing financing from traditional institutions. Turning to these alternative sources often comes with higher interest rates and increased financial strain. The CMHC points out another concerning trend: an increase in financial strain among borrowers, leading to higher delinquency rates on other financial products like car loans and credit cards. This suggests that homeowners with longer amortization periods may be facing heightened financial stress and struggling to meet their various financial obligations. The article by Bryan Labby sheds light on the growing prevalence of longer mortgage amortization periods in Canada and the various factors driving this trend. While these extended terms may provide temporary relief from rising interest rates, they come with significant long-term consequences, including higher interest costs, delayed savings, and potential setbacks in retirement planning. Homeowners are faced with difficult decisions about their financial future. And as interest rates continue to fluctuate, it remains to be seen how this trend will evolve and impact the broader Canadian housing market. The hidden risks of extended mortgage amortization in Canada. Introduction. In the first portion of this video, we examined the growing trend of extended mortgage amortization periods in Canada, shedding light on the reasons behind this shift and its immediate implications for homeowners. While opting for longer amortization periods may provide short-term financial relief, it is essential to explore the potential downside risks and problems associated with this trend. In the following portion of the video, we will discuss the financial prudence, economic realities, and financial risks that mortgage holders and the broader economy may face in the wake of these extended amortization periods allowed by Canadian banks. Financial prudence versus immediate relief. One of the primary concerns with extended mortgage amortization is the trade-off between immediate financial relief and long-term prudence. While homeowners may enjoy reduced monthly payments, they often fail to realize that this comes at the cost of significantly higher interest payments over the life of the mortgage. By extending the amortization period, borrowers may find themselves buying time at the expense of their financial future. This raises questions about whether the short-term relief is worth the long-term financial burden. Economic realities and rising interest rates. As economic conditions evolve, so do interest rates. The Bank of Canada's recent moves to increase its benchmark interest rate have already had an impact on borrowers with variable-rate mortgages. Those who initially opted for variable rates and are now extending their amortization periods to combat rising interest costs must grapple with the reality that interest rates may continue to fluctuate. This exposes them to potential future increases, further eroding their financial stability. The risk of falling home equity. Longer amortization periods not only lead to higher interest costs but also slow down the pace at which homeowners build equity in their properties. With a larger portion of their monthly payments going towards interest, homeowners' equity growth is stunted. This means that, even after years of making mortgage payments, they may still have minimal ownership in their homes. In the event of a housing market downturn, this lack of equity can leave homeowners vulnerable to financial losses, especially if they need to sell their homes. Savings and retirement implications. Perhaps the most significant concern with extended mortgage amortization is its impact on savings and retirement planning. Homeowners who commit to longer repayment terms often find it challenging to allocate funds towards other financial goals, such as saving for emergencies, investing for retirement, or funding their children's education. The lure of lower monthly payments can blindside individuals to the long-term consequences of these financial decisions, potentially jeopardizing their financial security in retirement. Financial stress and delinquency. Extended mortgage terms can contribute to higher levels of financial stress among borrowers. While they may initially reduce monthly payment obligations, these homeowners may still struggle to meet other financial commitments, such as car loans and credit card debt. This financial strain can lead to an increase in delinquency rates on other debts, further exacerbating financial instability and negatively impacting credit scores. The broader economic impact. Beyond individual financial concerns, there is a broader economic implication to consider. A significant portion of mortgages in Canada now have amortization periods longer than 25 years. This could result in a potential drag on economic growth, as households divert a substantial portion of their income towards servicing debt rather than contributing to consumption or investment. This, in turn, could hinder overall economic recovery and stability. The role of regulatory oversight. In light of these concerns, it becomes essential to question the role of regulatory oversight. Should Canadian authorities consider implementing stricter regulations on mortgage terms to mitigate the risks associated with extended amortization periods? Balancing homeowners' immediate financial needs with the long-term health of the housing market and the broader economy is a delicate act that warrants careful consideration. Conclusion. While extended mortgage amortization periods may seem like an appealing solution to immediate financial challenges, It's crucial for homeowners and policymakers to recognize the hidden risks and potential problems associated with this trend. These risks include higher interest costs, slower home equity growth, compromised savings and retirement plans, increased financial stress, and broader economic implications. As Canadians make decisions about their mortgages, it's essential to strike a balance between short-term relief and long-term financial prudence, all while considering the impact on the nation's economic well-being. Regulatory authorities may need to take a closer look at the growing prevalence of extended mortgage terms and their potential consequences for both individual borrowers and the Canadian economy as a whole. What do you think? Should Canadian mortgage holders choose to participate in these longer amortization periods, or are they actually just kicking the can down the road? Are longer amortizations just helping homeowners dig themselves a deeper hole that most will not be able to get out of? If their equity has increased, one way out of this mess may be to sell their homes now before prices decline further. Are there any other options they could realistically choose? Please join in on the conversation by leaving a comment. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.